dividend is a portion of the profit which is given to the equity shareholders. Okay? It's a portion of the profit which gets given, which gets paid to the shareholders. It's a portion of the profit which gets paid to the shareholders. Now, who's a shareholder? A shareholder is one who invests into shares of a company. Now, a shareholder is a person who has decided to forego his capital, and he has decided to invest this capital into into a company, and now the company is collecting this capital, and they in turn are going to utilize it to grow. So, as a share investor would get money in two forms. He would get returns out of shares in two forms. One is capital appreciation. What is meant by capital appreciation? The share prices continues to increase. Okay, from 10 rupee it became 100 it became 200, 300. This is called as capital appreciation. This is one way an investor makes money. Another way in which an investor would make money is in the form of dividend. So what is dividend? Dividend is a portion of the profit which gets paid to the investor. It's a portion of the profit which gets paid to the investor. So the company has made some amount of profit. A portion of this profit will now get paid to the investor. Last class, we had learned EBIT EPS. We had learned the computation of EPS. We saw how we will go about determining earnings available to equity shareholders, and then we will try and calculate the EPS level. So we are trying to calculate the EPS level. We are trying to understand what is the possible amount of money the investor can earn in the form of dividend. Now, dividends, it has to be, these are periodic payments, which means this dividends are usually paid maybe once in a year or twice a year. Okay? It is paid either once in a year or twice a year. Now, this is the monetary compensation an investor gets for sacrificing his capital and investing money into shares. Okay? This is the monetary benefit an investor enjoys for sacrificing his capital and putting money into the shares. Now, okay, I've put in the definition of dividend over here. Dividend is a distribution of a portion of company's earning decided by the board of directors to a class of its investors. So one very important thing that you have to remember is the dividend decisions have to be taken by the board of directors. Okay, board of directors will take the dividend decision. Now there are two kinds of dividends a company can pay: final dividend, interim dividend. Final dividend, the dividend which is paid at the end of the financial year, is called as final dividend. Any dividend which is paid during the course of the financial year, that is called as interim dividend. So what are the differences between final dividend and interim dividend? Final dividend you pay after determining or after computing or after preparing your books of accounts. You know what is the exact profit your business has made. Then you would decide on the dividend. That dividend is called as final dividend. Then there is something which is called as interim dividend. So interim dividend, the company's board of directors notices that the company is doing extremely well in terms of their maybe in terms of their projections, maybe in terms of the forecast. The company is doing really well, and the company wants to keep the shareholders happy. In such cases, they would pay what is called as interim dividend. Okay? So final dividend paid after determining books of accounts, after preparing books of accounts. Interim dividend during the financial year. Final dividend does not need the approval. Final dividend needs the approval of board of directors as well as AGM, annual general meeting. So it needs these two people to approve, and only then dividend can be paid. In the case of interim dividend, what happens is interim dividend can be decided and it can be approved by board of directors. It does not need or they did not wait for an AGM to be hosted in the case of interim dividend. Next, forms of dividend. Now, what forms can dividend be paid to an investor? Okay, what are the different forms in which you can end up paying dividend to an investor? Now, first is cash dividend. Okay. So here the returns, the profit which is made by the firm is paid in the form of cash itself. It is paid in the form of cash itself. That dividend is called as cash dividend. Okay. Then we have scrip dividend, and then okay, there's one. Okay, so we have scrip dividend. Okay, scrip dividend we don't have in India. In scrip dividend, choice is given to the investor. So I think okay. So I let me just quickly run you through the names, and then I'll pick up on the explanation one by one. Cash dividend, scrip dividend, stock dividend, property dividend. The first type of dividend was cash dividend. Here, the payment is made by the company. The payment happens in the form of cash. And one good thing for an investor is this may be a regular source of income, in the sense this may be like an additional income for the investor. Okay? But one catch that you have to remember here is the income that an investor earns from dividend, it is taxable in nature. Okay? It is taxable in nature. So if you were to fill out your income tax returns sheet, you will have to fill in you have to disclose the dividend that you have earned as income from other sources. Okay? You have to pay taxes for that. Okay? So that's what happens in the form of cash dividend. Next is stock dividend. So in the case of stock dividend, what happens is, okay, so stock dividend, what happens is, instead of giving cash, more stock is given to the investor. Okay, more stock is given to the investor. So instead of giving him cash, equivalent form of monetary value of the cash, that in terms of stock is given to the investor. So one good thing for the investor is here he ends up accumulating more and more stocks. Okay, he ends up accumulating more and more stocks in the case of stock dividend. Now, another flip side of this is that the EPS on a share will reduce. Now, why does EPS on the share reduce? Let's go back to last classes. Last class, we had learned how to calculate EPS. We learned that EPS is computed by earnings available to equity shareholders, the whole divided by total number of shares. So here, what will happen is the company is issuing more and more and more shares. So the number of shares is increasing. The number of shares which the firm has is increasing. So this may not be a good thing for the existing shareholders. Then we have scrip dividend. Now, in the case of scrip dividend, the investor is given a choice. Okay? So in the previous cases, cash dividend and stock dividend, they are not given a choice. Okay? They are not given a choice. Here, the investor can choose between cash and stock. Okay? He has the freedom to choose between cash and stock. So that is what makes scrip dividend different from the other two types of dividend. Cash dividend, physical cash is paid. Stock dividend, most shares are paid to the investor. Scrip dividend, the investor is given a choice. He is given a choice to choose between cash or stock of the company. So depending on what he chooses, he will be paid dividend accordingly. The last form of dividend is called as property dividend. Okay, the last form of dividend is called as property dividend. Now, in property dividend, what happens is physical property is given to the assets are given to the investor. Assets are given to the investor. Now, this usually happens in the case of ownership securities. Okay, so what will happen is the promoter securities. I'm so sorry, I think I used the wrong term previously. This is what happens in the case of promoter securities. So, for example, in the case of Reliance Industries, 75% of shares of Reliance Industries was owned by Ambani family. 75% of shares of the company is owned by Ambani family. So instead of paying them cash dividend, the board of directors decided to give them maybe a property. Okay? They decide to give them a property. So that kind of dividend is called as property dividend. Okay? So that kind of dividend is called as property dividend. So we have discussed 4 types of dividend: cash dividend, stock dividend, scrip dividend, property dividend. Cash dividend, cash gets paid. Stock dividend, more shares are paid. Property dividend, scrip dividend, the investor is given a choice between cash or stock, and then you have property dividend. In property dividend, what happens is property physical asset is given to the investor. Okay. Any questions so far? Okay, if that's the case, yes, someone had a query?
No questions.
Okay, I think Hitesh has a question. Hitesh, would you like to type and ask me the question? Or let me see, are you muted? Hitesh. Hitesh, can you try talking?
Sir, is it property dividend is risky, sir?
Property dividend is not risky, but what you have to remember is property dividend cannot be paid to all investors. Okay, so for example, let's say I have one share in a company. Now, property worth property on that one share of stock that I own, they have to pay me as dividend. So then you can imagine what will be the value of that property. Okay. Now, usually, if you look at in India, the trend is like they will pay 1 rupee, 2 rupee, and all that. Where will you get land worth maybe, or where will you get a property worth 2 rupees? So in the case of so property dividend, you cannot pay to all categories of investors. That usually property dividend is followed in the case of promoter investors. So for example, Tata and Sons, Ratan Tata is a main promoter. Okay, so Tata and Sons decide to give a flat to Ratan Tata in the form of dividend. So in such cases, what happens is usually promoters would own a sizable. They would own a sizable. They will own a sizable amount of shares in a company, and it would make more sense for the company to pay property to them. So there's no risk in the case of property dividend. It's just that it does not make sense in paying property dividend to all your categories of your investors. Any other questions, Hitesh?
No, sir.
Okay. Anyone else?
Yes, sir. Hello.
Yes.
Yes, sir. Israel here.
Yeah.
Yes, sir. I just want to know that whether the property dividend is just like land or property or something like. Is it any asset or only the land and stuff?
It can be any asset, but usually the category, the types of assets which are paid are land and flats.
Okay.
I've not seen any other type of. So, for example, I forgot the brand name. Raymond.
Okay.
It belongs to, I think, a family called as Saxena. I forgot. So I think the case of Raymond, what happened was the father wrote a will to the son, and then the son threw him out of the company. Now, in that case, the father is now he owns a property, but that property is on a litigation in this line because it was a property dividend which Raymond had paid this father. Now it is on a litigation. So usually it is paid. It is immovable assets which are usually paid.
Okay.
It is usually immovable assets which are paid.
Okay.
Okay. Any other queries? Okay. So if that's the case, I think I'll proceed. Okay, excuse me for a minute. Okay, so any more queries with regards to forms of dividend? Okay, in that case, let me continue. Okay. Next, what we are going to discuss is dividend policy. Okay. Dividend policy. Now, what is meant by dividend policy? It is a policy which is framed by the board of directors, or it is a strategy, or it is the approach which the board of directors adopt in terms of paying dividend to the investors. So it is the approach which is adopted by the board of directors to pay dividend to the investors. So dividend policy, there are five types of dividend policies the firm can have. There are five types of dividend policy a firm can have: residual dividend, regular dividend, stable dividend, irregular dividend, no dividend. Okay, there are five types of dividend policies the board of directors can adopt. So what you have to remember is this is the approach which is taken by the board of directors in terms of paying dividend to the investors. Okay, this is the approach which is adopted by the board of directors to pay dividend to the investors. So five types: residual, regular, stable, irregular, and then no dividend. So now let's now let's look at these one by one. The first is residual dividend. In residual dividend, what the firm does at first is it tries meeting or it tries fulfilling all its obligations. Okay? So they will keep money aside. They will keep money aside in the form of retained earnings. They will try and create reserves. They will try and create provisions. They will try and set aside some money for future plans, etc. And after fulfilling all the firm's commitments, if there is some money remaining, then they will pay that to the investor. So if there is any residue, if there is any leftover, then the company will think of paying dividend. Okay? So here, the priority is to fulfill the organization's needs. Okay? The first need, the first objective, or the primary focus for the firm would be to try and fulfill the commitments or the needs of the organization. If some money is still remaining, then we shall think of paying dividend to the shareholders. That's what happens in residual. Regular dividend, what happens is the firm decides to pay dividend, or the board of directors has a policy to declare dividend regularly. So it may not be a fixed amount of money, but for sure some amount of money will be paid as dividend every year. Okay, that is what happens in regular dividend. Then you have stable dividend. In stable dividend, the board of directors adopt a policy, or they adopt a stand by which they will pay a certain proportion of the profit every year. So let's say 20% of the profit. Okay, so 20% of, let's say this year you made 1 lakh, so 20% of 1 lakh for sure will be paid as dividend. Let's say next year it is 10 lakhs, so 20% of 10 lakhs will be paid as dividend. So that's what happens in stable dividend. So the difference between regular dividend and stable dividend: regular dividend will be paid for sure. There is no question. There is definitely a sizable amount of money that will be paid as dividend. But in case of stable dividend, we can assume, or we have an understanding about what is the quantum of money which is coming, what is the percentage of money which is coming. Irregular dividend, they don't have a stand at all. Sometimes they may pay dividend, sometimes they may not pay dividend. That's what happens in the case of irregular dividend. No dividend, company or board of directors, they do not believe in paying anything at all to the investors. That approach is called as no dividend policy. So five types of dividend policy the board of directors can adopt: residual, regular, stable, irregular, no dividend. Residual, anything left over, we will pay you. Regular, we will pay you something, but it will be a pretty good amount. Stable, we have decided on a percentage. That percentage, irrespective of the circumstances, for sure we shall pay you. Irregular, we may pay you, we may not pay you. If you get, be happy. If you don't get, please don't complain. No dividend, we don't believe in giving you dividend at all. Thank you for contributing your capital. We are more than happy. please accept our love and regards. That is no dividend policy. So any questions on this? Okay, if that's the case, we will quickly move on. The next thing that we have to discuss is factors which influence factors which influence dividend policy of a firm. Now, I have a request. This is a section C question from this chapter. Okay, factors which influence dividend policy. Okay, factors which influence dividend policy. This is a section C question in your examination. So in this line, there are 9 factors which can influence your dividend policy. First is availability of liquid funds. How much of money do you have? Okay, do you have so the amount of dividend that you will declare, it depends on how much of profit is available with you. How much excuse me for a minute. Yes. Sorry about that. How much of money is available with you? Depending on that, you will decide on your dividend. So if you have more money, you will pay more dividend. If you have less money, you will pay less dividend. Financial needs of the firm. Okay, so does your firm have got any financial commitments? Does your firm have any needs? Does it have to keep some amount of money aside as retained earnings, etc.? So for those kind of needs, you would evaluate those kind of needs, and then you will take a decision of how much of money should you pay as dividend. Investment opportunities. Does the firm have any investment opportunities in front of it? Are they looking at expanding their capacity? Are they looking at expanding into new regions? Are they looking at expanding into new geographies? So depending on that, or they want to encash on these opportunities, depending on that, they want to take a stand. That is investment opportunity. Economic conditions. This is very important. So depending on the prevailing economic conditions, you will take a stand whether to pay dividend or not. Now, if you let's pick up on the present example. As of now, almost all the industries in India are affected by COVID lockdown. So I'm pretty sure for the last financial year, most of these firms are not likely to declare any sizable amount of money as dividend, because whatever profit they have earned last year, they're going to be a little cautious. They're going to keep that aside as reserves or retained earnings to see how the future developments are taking place. Okay, so how an economic condition has impacted the dividend which is going to be paid by the company. Nature and size. So depending on the kind of company you are, you have to decide on your dividend amounts. So usually your manufacturing companies, they have usually this practice of paying dividend regularly. Okay, manufacturing companies, they have this practice of paying dividend regularly. Stability of earning. How regular or what is your stability in terms of your profit? How consistent are you in terms of your profit levels? So depending on that, you will take a stand and you will decide on the dividend amount. Next is access to capital market. What is the general perception about your company in the capital market? Do people look at your company highly? Do they regard it highly, or do they don't give much of importance to it? So that is what is meant by access to capital market. Next is tax implications. Now, tax implications. There are two parts to this. One is from an investor's point of view. Now, from an investor's point of view, investor has to pay tax on dividend. Okay? Investor has to pay tax on dividend. So, for example, in the case of, let's say, Mukesh Ambani, if he gets dividend if Reliance Industry declares a dividend, then he owns 75% of the company, and then the amount of excuse me for a minute. Aspects, and then they will decide on their dividend policy. Then the last is requirements of the shareholder. What are the sentiments of the shareholders? Are the shareholders expecting a lot of dividend, or is it okay if you don't pay them dividend? So depending on the investor sentiment, then you can take a decision to pay dividend or not. Okay, so these are the factors which influence dividend policy in a firm. I'll quickly run through them once again. Availability of liquidity funds, financial needs of the firm, investment opportunities, economic condition, nature and size of business, stability of earning, access to capital market, tax implication, requirement of shareholders.